Okay, hello, welcome. It is Tuesday. We're feeling great. It's sunny out, it's warm. So, we're gonna finish up the dry cleaning service financial model today. Yesterday on it, I started, got all the new tabs imported, all the logic re-referenced, and I rebuilt the entire revenue assumptions as well as added a capacity checker. So this thing is awesome. A lot of great upgrades. This model just got substantially better than it was. We're going to continue on today with getting all of the financial statements linked up properly and the summaries and sanity checks. Before I get started, remember, don't forget to check out smarthelping.com. The model I'm actually upgrading right now is in the industry specific bundle, or you can buy it individually. It's right here, dry cleaning, $45 one-time fee. So this is what's getting the upgrade. And check out more financial models. I've got stuff for SaaS, a lot of SaaS stuff, and I've used these a lot in consulting too. Um, Software as a service, recurring revenue businesses. I've got a whole bunch of stuff with that. I've got joint venture models, cash flow waterfalls, standard IRR hurdle stuff here at the top. That's some preferred equity stuff, um, different structures, preferred returns, multifamily real estate, managing basically an investment fund, all kinds of stuff here. Real estate specific models, mobile home park, unit based acquisition, self storage, mixed use, multifamily, uh, inventory. And then if you want everything, I sell everything on the site for $999. There's over 100 unique templates, all kinds of different things. If you use Excel or Google Sheets to do anything, there's just a tons of value here. Usually, I mean, I might do a project for $600 to $1,000, and that's just one template, and you've got over 100. So tons of value. Let's get our link up here to Twitter, do a sound check, and then we'll get started. Twitter, do a sound check, and then we'll get started. That sounds good. Let's get our Twitter over here. Live modeling. Check this stat. Okay. All right. So here we go. Uh, Let me see if there's anything. Just got to get my bearings. So interest or amortization, we got to update first. And I'm pulling all this from an annual only model. Let's see, which one was it? What was it? Ah, the food truck. Food truck, where was that? Right here. So I'm just checking how I did the logic for the debt real quick. Let's see. So this was just 120. Year 2030, so it's 10 up to 10 years, 100 month, 120. Ah, right. So I had to do the year numbers over here. So let's add that. Wait, year. Oh, it has year numbers. Okay, so let's update this calc. So here's our year numbers. Let's update this to do potentially more than or less than 12 payments a year. Make sure that works. 6. Okay, perfect. All right. Update the formatting here. I don't know when I switched from going from this one to this one, but it was sometime a couple years ago because the older templates have that format. Let's bring this down. And then how did I Here it was. This is what we need. Formatted, I believe it should just be for year. Okay. Oh, we need the years in here too. So 2021 gives us a validation. Lots of little things to do to make this very easy for the end user to just pick up and go without any issue. Okay. So what other logic did I have here? I must have had something. Yep, right there. So we just want this first string, checking if it is the end month or not. And if it is, then it should, bring this down. There's no late fees. Okay, so if that's there, I'll bring this down. All that stays. That stays. All right, let's see if that worked. Yep. And then, oh wait, no, 150. Hold on. 1, 2, 3. So 10. It doesn't. We'll put a 12 here because it doesn't hit the exact end month on that. So it's a pretty rare case. Okay, so no, we're still off. Let's see what is going on here. Oh, so this has to come down. Now let's try. There we go, zeroed out. So whatever end month we pick, if we are including terminal value, the loan will be paid off in that year. Let's say we put it to 2026. You now see at the end of, well, wait, January 20. Hold on. All this is offset by 1. This has to come down. There we go. So end of year 6, it's fully repaid. If we were to select no on not including terminal value, it'll just run through its course, full amortization schedule based on the terms. Okay, and now I should be able to put a 6 here, and that should work. Let's turn this back on. Perfect. Yeah, it was just those other updates. So now, yeah, you can do 6 months, payments per year, or 6 payments a year, 3 payments a year, and this all updates. Perfect. Usually it'll be 12 with the amortization, but it might not be. All right, so that's good and all done. That's going to flow over to all the amortization rows on the income statement. CapEx here. All right, so we're assuming everything happened in the first year for any CapEx items for the dry cleaning service, so that's fine. That's fine. So we could change this to match. So like this could be a building. This could be dry cleaning, equipment, one, in extra slots. Okay, that's fine. This is good. That's good. I gotta be careful here because I'm doing annual only model. So I just gotta make sure I don't miss any formula references. Let's give this a nice light border. Okay, that's fine for now. Yeah, we'll deal with that. We'll finish that. Okay, so annual detail. This is pretty much where we left off. We had all this updated. We added variable costs. We added all these different revenue sources with add-ons, dry cleaning, pressing, stain removal, garment delivery, special material cleaning. This is a count of the types of services provided per year for each type. Top line revenue, variable costs, contribution margin, fixed costs. We got down to EBITDA, debt service, which looks like it's going fine. Yep. Startup costs, let's put this in here. Sale of the business. So here, all we're going to do is say if, actually, these will all be populated after I do the cash flow statement. So don't worry about this. We will get into that after. So right now we basically have debt service, startup costs, and then we'll update this after we finish the other financial statements. So this is fine for now. We'll come back here. Executive summary distributions, we'll do this at the very end. So next step logically is this. So here we're obviously, we can put all the revenue streams in here. So 1, 2, 3, I think we had 5. One, two, three, four, five. Okay, and the revenue, we've already got it built, so all we're doing is just referencing that for the income statement. Now this is where things get, it's always a puzzle doing financial modeling like this, because everything has to match. Here, and so we need to stop if, see, there's some logic going on here. We need to say if year of this model is greater than the end year, then 0. And then we'll drag that all the way through. First of all, make sure it works. It does not, so what did I do? Year of that is greater than global C6, which is, let's see, year. Oh, it is a date. It is a date. It is a date. Okay. So now I can just say, it doesn't have to be year of F3s. You can just be F3. Perfect. Now if I were to say end in 2030, full 10 years, goes out, and it should be the same numbers as it was. Yep, okay. Perfect. And we'll put that in front of all these. Sorry for the noise. Sorry for the noise. Drag these over. Let's just put the second to last year to make sure it's working. Okay, and these all go to 0, 0, 0. That's fine. We'll do if error on these. A lot of modeling, once you know, so there's multiple aspects. You've got to know the financial logic, what makes sense. You need to know how to build the logic to make give the user a good chance to forecast revenues based on whatever assumptions there are. You need to not be lazy with the inputs, because it'll make the user have to then do it. So just doing simple things like if error there to make that look a little bit cleaner. Just little stuff like that. Here, if F19 is 0, just so you don't see it. There we go. That looks cleaner than at minus 100% because we're just done for the year. Okay, now these are these just drug down? Let me see. Yeah, perfect. That's awesome. So I can just go here like this, drag it over. Oh, I can't do that. I need to lock F3 first. No need to do it in year one because you're not going to stop operations in year one before you start. So, and there's different logic in year one versus 2 through 10 because of the growth. Okay, so now we have the date formatting or potential for end year. Okay, so that's good. Let's get back to the income statement. So now that can work properly. This is year over year change, and this will actually be the same as this. Okay, so cost of goods sold, we have some variable costs in here we'll put. Let's see, 1, 2, 3, 4, 5. Let's clear the floor. Well, actually just go here, copy, paste. And these are not necessarily variable cost or cost of goods sold, they're variable costs, which is different. And we got that right here. Okay, looking good. Looking good. OpEx here, we'll just do basically, let's look at this. So OpEx, we just have fixed costs and then startup costs. This could be SG and A, sales, general and administrative, and then startup costs. Okay, looking good, looking good. EBITDA, that should match, so 5,016,406. We're out. Oh, because it's 13,000, so that's fine. Interest. Okay, so here some debt interest is in C. If L is that, yeah. So amortization schedule is a little bit different. Columns in the import, that's fine. Perfect. So interest is deductible, so that's why we have this over here on the income statement, but principal payments are not tax deductible, so that's not there. Um, Sorry. Okay, depreciation, and this should be fine. This is just pulling the CapEx schedule based on what's in there. Useful life of 10 years, 5. So items 3 and 4 are only going 5 years. Perfect. And if we were to change this to say useful life of 7, 50, maybe 30. Now you can see these all go out to year 7. This one's going out for a lot longer. Okay, so that's good. This logic is fine. Taxes, looking good. And this is for the sale, which, so if we go to terminal value, final year EBITDA, this should be indexing income statement 34. Let's make sure that's right. EBITDA, yep, 34. And then the multiple of that, so we're valuing at 2.6 million, 100% is going to extraordinary income. Now, if you don't want to deal with taxes or don't need to show them, just zero these out and then they will not show up. Okay, so income statement's now populated. Let's hop on over to the cash flow statement. This is pulling, so operating activities is just going to pull from the income statement itself, taxes, interest, OPEX, customer receipts. So we have that cash flow. We have cash flow from investing, so the CapEx, which always happens in year 1 for this model because it's annual only. End month, it's happening in 9 because we put it to 9, so that's exit value. Then we have cash flow from financing, principal repayment. So here we got to adjust a column, right? So it's not D, it is principal. Oh wait, it is D. If this is greater than, this has to be L. There we go. That activity, and then sale company stock. So this is equity raised or any investments into the company we'll have to put here. So this is tricky. Let's see what we did on the food truck model for this one. So cap table, control 16. We took min annual detail 42. Okay, so total cash flow. So I asked after adding all this other stuff. All right, so let's add all the other stuff to the annual detail. So this is actually very useful for getting our cash flow. So we have exit proceeds. We have taxes that are not on here. We have CapEx. And then after all that, we'll have cash flow and cumulative cash flow. And now we go to the cash flow statement. Here's our exit proceeds. Whoops. There we go. Taxes. I'm bringing those through as a positive because I'm just going to plus or minus each one. CapEx. Okay, so cash flow is just EBITDA minus debt service minus startup costs plus extra proceeds minus tax minus capex. Oh. So in this case, we're making money in year one. We're only spending, let's see, year zero, we just have some startup costs, initial investments in this in the scenario. So it's gonna go like this. Now, and honestly, so for this, I'm thinking it probably makes more sense to put the capex in year zero. And let me see, did we do that here? No, but I think, oh yeah, I did. I did for the cash flow. So see here, we assumed the startup costs hit in year zero, which makes sense for this kind of style. Okay, we're good on the food truck model. So let's say, where are we? Annual detail. So the actual cash flow for period zero, we also want to subtract out capex here. And then in here, we don't need to subtract it out, or else we'll be double counting. So it's still the same end number, 5687. Yeah, 5687. But the timing is a little bit different. Normally on a monthly model, you don't have to worry about that, but annual only, we kind of do that finessing. Okay. So there's cash flow, cumulative cash flow. So this is a minimum. So this will cover your startup costs and your initial capex. And then you've got operational income for the rest of the years. The only time you really have a burn is if your revenues are, or your contribution margin is less than your fixed costs, whatever they may be. And if you do, that will add into the total equity required. Okay, so 84 is our cumulative cash flow. Let's reference that right here. 283,000, that'll flow to the cap table. You can define who's going to contribute that and how much of the company they get. Make sure this is always zero down here. That's checking all the calcs. Make sure you haven't given too much or too little. Okay. Getting some text messages from wife. Yep, doing good. Just streaming. Okay. Oh, discounted cash flow analysis. So let's do this. Shoot, zero. Right. So discounted cash flow. This, and then we're discounting it at this discount rate. Net present value. Now you should know the internal rate of return is just the discount rate that you use to get the future present value of the future cash flows to equal the initial investment. Okay, so, and to check that, we can go over, well, actually we haven't gone to the balance sheet, but I think our balance sheet is actually done. I think we're done with it. Because it is balanced. liabilities equal owner's equity, or assets equal liabilities plus owner's equity. We've got our investments in there, debt, cash. So the difference of this should be if I go this here minus our 5,737,809. Oh, oh, we're missing something, or these aren't connecting exactly. So we'll go this minus balance sheet cash flow. Oh, how do I get a circular reference error? Can't have it. Ah, here we go. Okay, so it's something to do with finding the minimum balance. Are we referencing something twice? Let me see here. Cash flow, but that should be fine. 17. I'm not referencing anything in here. This is debt schedule, cap table. So this should be set up cash flow annual. But there should not be any circular reference errors, so we're going to see what is going on here. Wait, is it the chat? Oh wait, no, there's still an error here, which is odd. Let me try it this way. Okay, I think it's something is referencing column O somewhere. Okay, so we're off by 333,000. And then, but if you minus the initial startup cost, or add those in, I mean, 50. So what's 50,000 even? $250. We're out by 50,000 even. Oh, that. Okay. So, we can have loan proceeds. And that's only going to be in year 1 or year 0 if it's in there at all. So we'll add that in to this calc. And there we go. So our check. Now what I'm trying to figure out, why is there a reference error here? Oh, I know why. Because it's taking the min of this total. this entire row. That's fine. All right, so here's the the cash balances. That's good. Uh, Balance sheet looks fine. Let's go out to year 10. Looking good. Okay. Let's do our executive summary. So it's high level. Now, what do I want on this? Probably just total revenue. Variable costs. Contribution margin. That's good. SG&A. We don't have anything here. Total expenses. Plus variable costs as well. Okay. Alrighty. Percentage. Now other cash flow items. So we have taxes in here. CapEx. It looks like it actually is already referencing it properly. Debt service. Let's put this down here and say other cash flow items. All right, looking good, looking good. Startup costs, proceeds. Let's format these all the same. Debt service. We don't need to make this a negative because it's coming through as a positive. And then cash flow. So here we'll take EBITDA. Again, we can add this here. Actually, we need to make all these the same logic, so this should be negative. Okay. Now this cash flow should match. However, we're going to bring in, we're going to put CapEx over here. And startup costs. Those would never be anywhere else, but they're based on how this model works. And same with loan proceeds. Those are all defaulted to year 0. Okay, so 6316. 6316. Let's do distribution. So this is our discounted cash flow analysis advanced version. We just need to sum up row 83. And then same thing here, but just any negative values. And then what row 4 is our reference row. Okay, so there's that. Remaining equity to use. So this is going to be our initial equity provided plus any financing minus startup costs and minus capex because we're assuming this year is 0. So we're using all of it up front, solving for 0. That's 233. Now, if we had some burn, let's say to do that, let's just lower this. Say it's 5 customers a day. Oh, now we have burn every year. Hold on. Let's say 15. So at some point, oh, now you are positive the whole time. Some number in between there, you're going to the fixed cost will be greater than the contribution margin. Let's see. Try 10. I just want to see a year or two of negative. Okay, that's fine. So year 1, we're basically breaking even year 1 and 2, and then we start to really go positive. So discount rate of 12% means that our IRR is higher than 12. Perfect. So there, see how that flows. That logic is really nice here. The actual IRR of the project is 9.9. And let's see, what are we doing here? Is it the same cash flows? Oh, no. So here we got to update this net present value calculation. It's just going to be the sum of this. So it's a negative, and that makes sense because the internal rate of return is like 9. So this would have to be like an 8% to go positive. Yeah, there we go. And you can see if I just copy this and drag it over, this will be a net present value of 0. Or close to it, 255. 98. That should be 0. Let me make sure the cash 233 0. Oh wait, no, that's off. That's off. That's off. A little bit different because this is assuming all the cash required is needed up front. So if there's any negative cash flows in year 1, 2, or 3, or etc., all that cash is required up front. Whereas this calculation is doing it by the period, which is probably more accurate, but it depends. I mean, if you don't know when that negative is going to happen, you're going to have the proceeds in there to be available whenever you need it. So that's why this is an older calc that I use, but I'm going to keep it in here. That's why now I use this format to do this kind of cash flow analysis. So 99 investors are contributing most of the money. They're not getting that much though, only 34% of the cash flow available. So negative IRR Owners are getting positive. Now these numbers are all arbitrary as well. Obviously, you'll put in your own revenue and cost and capex assumptions, cap table, all this stuff. I'm just making sure the logic works, so when someone comes in and starts building their own financial forecast, it will work. All right, so executive summary, this looks good. Distribution's good. Let's look at the sanity checks. So balance sheet, 60. Yep, that's a 60. Annual detail check against balance sheet. So this is actually going to be the calc we already did right there. Next sanity check. And I like to have all the sanity checks nice in one spot so you can see everything. And if any of these are not zero, there's an error somewhere. And you've either broken a reference or done something that's not logical. Executive summary to annual detail. So here, this minus that should always be zero. And then distributions. Oh, let's look at the cap table real quick. Oh, that looks like it's working now that we updated the distributions tab. Perfect. You can see these overall IRRs match, and then there's also individual IRRs for each investment row. These match the overall distributions. Okay, where was I? So distributions B9 minus annual detail. So that's going to be that. Perfect. And then individuals distributions, that's good. That's just checking. And 57 of these here. Looking good, looking good. All right, so sanity checks are done. Let's start playing with some of this stuff and making sure it works. Hit no here. Oh, okay, there's error. 595 if no terminal value happens. So we're out 9,000, so there's something going on. 9501. Debt service. Because we didn't have the right formula in here. So this needs to say if this is greater than end month, end year, throw out a zero. Otherwise, you can do the calc. Perfect. Okay, then this is why we do sanity checks to make sure the math is working. All right, so good. Let's go back to your 2030. Perfect. All right, looks good. So yeah, you can get more industry-specific models there on the smartway.com industries tab. I'm going to do a video overview of this model probably today that just is a quick 5 or 7 minute video going through each tab. And then yeah, that's it. You could buy the model. The model will be here under industries, dry cleaning, or you can just search dry cleaning right here. And it's right there. I'm going to replace with a new overview video with all these updates. This model is so much better. It has got a huge facelift. I'm going to write about all the updates down here. Still, the price will still be $45, a huge value for what you're getting in this template. And then I'll post it up. Don't forget, check out Financial Models. Again, buy all the models on the site for $9.99. You can also buy in bulk with these bundle discounts for the different categories. And all the models will be available upon purchase. You can download them right away. Alrighty, well, that's all I got for you. I'm definitely doing a lot more content today, or this week. So this was a good start. We got the dry cleaning model, startup model completely done, and I'm going to be doing the startup model updates until I finish them all. I'm working from the most popular ones to the least popular, or most sales to least sales, but that doesn't necessarily mean popularity because I've got newer templates that just haven't had the sales because they haven't been around as long. But anyway, I'm updating all of them, and then once that's done, well, we'll have three statement modeling integration into all of the site templates on the site. Right now, we're through the top. I think I don't know. I've been doing this since January 2022, so 5 months. We've been doing about one a week, and at the beginning we were doing a couple a week. Um, I think I'm through like coming up on 30, 35, maybe even maybe 30, 35. So I've got about 25 more to go, and then I will start doing new ones. The very last one that I did was a franchisor licensing one. That's the last new template I did back in it was this one here. And I actually built a three statement model into it to start, and that was kind of my start of doing all these. So we've done all the startup models in this top 50 are done. I'm now working on ones that are past that, and I can't wait for it to be done, and not then I can start live streaming cool stuff like I did last Friday, where you saw me build like the Google Sheets tracker, to-do list tracker. Um, but this went fast, so I've got Wednesday, Thursday, Friday. I might go and do some more unique like one pager templates or financial calculators that I think are useful. We'll see what I end up coming across, but yep, take it easy. I'll see you guys on the next